Welcome to the CFA Society India podcast, where society members engage in conversations with industry experts to bring you unique insights. This podcast represents the views and opinions of the originally featured speaker and is posted with their express consent. The podcast is meant for educational purposes only. It should not be construed as research, recommendation, solicitation, or investment advice by CFA Society India. Now, let's dive into today's episode.
Hi everyone, welcome to CFA Society India podcast. My name is Kislay Upadhyay and I'm founder and fund manager at Fidelity Investments. The topic we are covering today is something I'm passionate about, so looking forward to this. Do you want to build, analyze and execute long-term objective investment strategies? If yes, then this podcast is for you. Investing or trading without data is nothing but gambling. Be it long-term fundamental story or short-term technical trend, it should always be validated, studied, and translated into numbers. Studying these numbers to discover insights on the fundamental economic or technical trends is called quant analysis. While quant is most often spoken of in the realm of trading, however, in the recent years, its applications for fundamental investing has absolutely exploded. Today, we will dive into rule-based or quant-based fundamental investing and cover major aspects of the practical application of the same. This podcast will be useful for individual investors, research analysts, and fund managers. Our guest is somebody who doesn't need an introduction to those familiar with quant-based fundamental investing space. We have Chetan Ganatra with us today. Now, Chetan Ganatra is working with Fidelity Business Services India as Director of Equity Research. Chetan has conducted workshops on quant-based fundamental investing and is a leading voice in this space. Welcome to the podcast, Chetan. Thank you for joining us today.
Thanks, Kislay. Thanks for the kind words.
Sure. So, shall we jump right into it?
For sure.
Great. Chetan, today we want to tackle the misconception that quant analysis is exclusively reserved for trading algorithms. To shed light on this topic, I want to ask, how is quant analysis playing a role in mainstream fundamental investing today?
So just to give you a background, I'm a fundamental research analyst from training, and I've spent most of my working career as a fundamental analyst. Quant research, the way we define it is very narrow, in my opinion. Anything to do with data can be classified as quant. Now, whether you're a fundamental analyst or a trader / investor, you would be looking at certain type of data for sure. And in fact, I actually was doing some Google research, and the first annual report was published in the year 1903 back in US, the modern annual report. And since then, fundamental research guys have been looking at P&L, balance sheet, cash flow statement for analyzing companies. So the idea is that anyone who looks at data from getting some insights out of it can be classified as doing some form of quant research, in my opinion.
Perfect. I think you have given one of the most exhaustive and comprehensive definition of quant, which probably covers decades and maybe centuries of investment practice. You spoke about how every form of data is into quant. But if I specifically ask, if I can make the statement, the degree of quant in fundamental investing has jumped tremendously over the last 5-10 years. Is that something you would agree with?
Yeah, for sure, Kislay. I mean, the idea is that the quality of data or the influx of data that we are receiving. So forget the number of companies which are increasing or getting listed on the stock exchanges, but the frequency with which we are getting the data in the standardized form has helped fundamental research analysts to get a lot of data into their research process and take fundamental research quant to a different degree. So for sure, what you're saying is absolutely correct. Though I would also like to highlight one point here that all of us know Professor Damodaran, and he's written a phenomenal book around narratives and numbers. So what was happening was earlier, if you look from a proportion perspective, narratives are something where you weave a story. Numbers are something that help you support or extend that story. Now, when we are building a buy case or a sell case for a company, that is part of the narrative. But now we are equipped with a lot of data which is coming into the system that helps us to tie up those data and narratives together to come up with an insight as to, or in fact, improve our degree of confidence in terms of how we look at things. The idea is when we are building any case for, let's say, a stock or a sector, whether we like it or not, in both cases, narratives are the way we think about things. But to substantiate that view, we will require data. And now, given we are getting data at such a fast pace, at a very good frequency, and even the quality of data is improved, that helps us to tie these two things together, where we can gain a higher degree of confidence as far as our narratives that we are forming. So I think, over a period of time, for sure, the fundamental research has greatly benefited in terms of incoming data, and the degree of quant that we are applying into fundamental research has gone up tremendously.
Okay. Now let's dive into the process of rule-based or quant investing. To those listening to know how to start about it. So what would you say is the first crucial step in this process?
So actually a very good question, because most of the time when you have a lot of data, the first question everyone asks is, what should I do with it? And first, for any kind of an analysis, not just quant, we should have a baseline thinking. In other words, a hypothesis that something works in a specific manner, or there is a relationship between two parameters / variables. Now that is the starting point. That starting point can then further be tested by looking at data. That does the data agrees or disagrees with our hypothesis. So in my opinion, the starting point in a way is forming a hypothesis, which is what we would like to test with the available data.
Okay, absolutely. The first crucial step will be to build an hypothesis. Build a hypothesis. Okay. You mentioned data also. So want to jump into data a little bit. As we know, data is abundant in today's financial markets. However, turning this data into actionable insights can actually be a daunting task. So how should practical, usable insights be drawn from data? If you can give an overview on this.
Sure. So you've rightly said that data is available in abundance. But what is more important for us is not just the quantity, but the quality as well. So one has to understand the data that we are working with is true or not. When I say true or not, does not mean that it should look pretty, but the way the data is should be the way it's supposed to be. So for example, if I'm doing a survey, I just collect those survey data and that's it. There's no change, no manipulation, no normalization, no standardization done to the data. So the first and foremost requirement is the quality of data that we receive. Then as a next step in getting the insights is to connect the hypothesis and data. So always keep hypothesis back in the mind when analyzing the data. I actually have an anecdote where how to think about data, hypothesis, and insights. So think of it like you're driving and data is like a road which you're traveling or with which you are traveling. Insights are like milestones which will come at every few intervals. And your hypothesis, whether data agrees or disagrees with it, is like a destination. So the idea is that you should be looking at data from multiple lenses. One should not focus that my hypothesis is this, I should just go in a specific direction. That's the beauty of data analysis, data insight, that there are like three people who are looking at the same set of data, working for the same hypothesis, can actually look from three different dimensions and can come up with a conclusion which may or may not be directly associated with the hypothesis, but has a certain degree of value. And those values can be termed as insights. So the insight may not necessarily be usable for that specific hypothesis, but just park it somewhere. At some point in time, you are testing something in a certain scenario, and that insight may be helpful for you. So that is how I think one should psychologically proceed, or that's the mindset one should have when looking at data and trying to derive insights out of it.
And very insightful. I remember you discussed an example with me of studying ROE of a particular industry, and you covered the different aspects of how useful insights can be derived from data. Would you mind sharing that with the audience?
Sure. So I'm looking at, let's say, an industry. The data would be basically, let's just take a simple example of ROE, right? Now there are like 5 companies within the sector, and I have a 10 years history of data. So what I have is, for one company, I have 10 years of ROE, and for 1 year, I have 5 companies with which I have the ROE data. Now, when I'm looking at this sample of data, the first question is, I mean, if I'm just doing a first level of analysis, I would be looking at how the industry structure is. That the answer will come from, does the industry consistently generate ROE which is higher than the cost of capital? Now, it doesn't have to be every year. Most of the things are more cyclical than we actually give them credit for. So there can be some variations. So when there are variations, the next question will be, what is the standard deviation of the ROE over the period? So the way you should think about is in steps. First step is, does ROE exceeds cost of equity in all the years? If the answer is no, then what are the deviations one should think about? What is the standard deviation of the data? Now, once we know that there is a certain standard deviation, then we should also think about what are the maximum ROE which is generated by the industry and what is the minimum ROE. That gives you the range in which one should be thinking, especially useful when you are trying to build a bull bear base case scenario for a industry or for a company. Then you should also think averages and means. Now, sorry, averages and median, I mean. So when you're looking at median, of course, the statistical significance is much different when you're taking averages. The tails may have certain impact, whereas you're looking at median, the frequency will have an impact. So there's no harm looking at both. No, don't always like stick with average. So that's another way of looking at it. Now, once you've got all these statistics for the population, then let's say you are analyzing a company, then you should look at the ROE in context of the industry. That one can do is, if I was doing the analysis, what I would probably do is I would take a company, its time series of ROE, and for each year, I would divide the ROE of the company by the industry ROE to just look at what has been the ratio between the two. So in other way, I would think of it more like a capture ratio. That if the industry is making a certain ROE, what is the capture ratio for this company? If it is always above 1, that's the company probably I would want to look more closely into. If it is below 1, then one should ask, can it revert back to 1? Or can it exceed 1? And once we form that hypothesis, then we can go back further deep down and think what would drive that ROE uplift for the company above the industry average. So, I mean, this is one example of just looking at one parameter on ROE. So what we have tried to do is try to look at ROE from different lenses. And everything will offer you a certain insight as to what is exactly going on in the industry. How should you be thinking about the industry? And how should you be thinking about a company within that industry? So I hope that that makes things clear for the viewers and you.
Absolutely. This example actually very beautifully exemplifies how data and why data should be looked at from every lens. As you mentioned, if there is an average of a number, let's say even if it is long-term index returns that an individual investor is trying to assess, or maybe long-term average return of a particular mutual fund, for example, then it is important to look at the average, but also the entire range of data, right from the lowest and the highest, the deviation, the worst returns and the best returns. So basically trying to look at the data from every angle to get complete insight out of it. This example beautifully exemplifies this. Okay. Okay, another aspect of data I wanted to cover, Chetan, was type of data. When diving into quant investing, understanding the type and frequency of data is very crucial. How should different data sets be seen, categorized, and used for different use cases? Also, how does the frequency of data collection, be it monthly, quarterly, annually, impact the investment strategy that is being constructed ultimately?
So Kislay, if you look at data, the first classification I would do is whether a data is binary or not. So binary data would be just having, let's say, a yes or a no answer to a question. So you're just doing a collection of yes, no, which is either you can be a binary 1 or zeros. Those are helpful from a understanding of what the regime we are in. I mean, are we in recession? No. Are we in a war scenario? Yes. So you can actually have a yes, no question answer as well. So that is one type of data. The other is non-binary type of data where It can be classified the RV example, which I took. So you have a time series data where for one company, you have 10 years of data. Second, you have for a single year, you have 5 companies reporting. So that we call as cross-sectional data. So if you combine both, in the statistical world, we call it as panel data. So there are multiple facets of data. Now, what we are trying to do will actually govern what type of data will we be using. So there's no standard rule that one should be using a certain type of data in all scenarios. Not everything can be used in each scenario. So one has to figure out the hypothesis first, figure out the data requirement of that hypothesis, and then proceed looking at the data. So that is as far as data is concerned. Now, you touched upon frequency of data. Now, the best example is stock price data, right? Not just daily, we get like intraday data on pretty much every minute, every second, the data is there for a stock price. Now, one thing we have to understand is every data comes with its own limitation. Now, for example, in case of binary, we just have 2 outcomes, yes or no. For example, it can be multiple binary scenarios as well, like low, medium, and high. So you can have 3 outcomes as well. But the idea is that the data is pretty well defined or sliced. So what we are getting is very clear indication as to what the data is telling us. But boundary between those data points is very clearly demarked. But in a real world scenario, we operate in a very gray area where, I mean, it's very difficult to like derive actionable insights when the data is like very categorically divided between these 2 or 3 scenarios. That is where time series data is quite helpful. Now, coming to the frequency again of the stock market prices that we witness, the higher the frequency, the problem is the data is coming at you at a very fast pace. And with every incoming data, there is noise there. Now, most of the time, as quant folks or people who are doing any kind of research, our job is to figure out where the signal exists in that whole stream of noise. There is a cost of computation, right? Second, once the signal generated, assume that it's a very good data where you get like very frequent signals. But what one has to understand is that acting on every signal is like taking a decision on every signal. And there is a cost attached to it as well. So not only the computational cost of filtering the signal out of the noise, but once the signal frequency increases, one has to take further actions on each signal. That itself is expensive. So there are a lot of trade-offs. So a slow signal will have, for example, if you are trading gives you a very good picture of what I'm talking about. Let's say there are 2 traders. One is working on a daily time frame and one is working on a monthly time frame. So for them, the parameters that they are looking at the stock price will actually vary. So one would just be focused on daily time frame. So the number of signals that that person will get would be much higher. Where the person who is looking on a monthly time frame data will get a lower number of signals. Now what happens is the person who is looking at daily data will have higher actions, or in other words, the portfolio parlance, we use the word called as churn. There will be higher churn for that person. Now with every action that the person takes, there is a chance that the drawdown is smaller or the amount of money on going wrong is smaller, but even the rewards could be lower as well. Whereas on the person who is looking at a monthly time frame data, there are good chances that the person is like a buy and hold investor to a certain degree. And if the signal does not come for, let's say, 60 months, the holding period becomes 5 years. So the person may actually end up with a 5-year of very good return for that specific stock. But in the interim, when the negative signal was not generated, the person may have actually lost some capital in the interim, which we call as drawdown through the process of holding. So one has to understand not just the data based on the frequency, but also on what you want to accomplish. So all of us work in a very professional environment. We have our own guardrails, boundaries in which we need to operate. So we can't be just someone like, I like this suits my personality and I'm going to follow this. There are a lot of institutional limitations that we all operate in. So one has to even tailor the data requirement based on that, not just on the hypothesis, which I mentioned earlier. I hope that answers some bit of your question.
It does, absolutely. What I take away from it is that no, the frequency of data needs to be matched with the use case and the premise in which the fund or the individual investor is operating under. And the trade-offs between the high frequency, the more number of signals, the noise, and associated negative trade-offs needs to be balanced and considered for the specific application that data is getting used for.
Yes.
Okay, that was insightful. Next, I want to jump into the topic that listeners probably are most excited about, which is how to go about security selection to build a portfolio. Is probably the most asked questions that I get. So could you share a guide on security selection process, covering the basic philosophy behind it and also the practical considerations of using let's say, a rule-based approach for security selection?
Sure. So I've been looking at a large pool of data, large pool of securities for quite some time, and we have actually adopted a couple of methods of filtering out securities, or in other way, I should not say filtering out, but like building the portfolio. One, what we classify as like a hard approach, where if I'm looking at, let's say, a pool of stocks, I have a lot of fundamental parameters listed for them. Let's say price to book, price to earning ratios, ROEs, leverage, and so on and so forth, margins. Now, if I start adding filters to it, let's say ROE has to be above 15%, just theoretically, please don't use it as it is. But the idea is, I'm just giving you an example. So ROE is greater than, let's say, a certain level, say 15%, debt to equity less than 0.5, price to earnings below a certain level, similarly price to book below a certain level. Now, when I'm sequentially applying these criteria on the data, what I'm doing is with every iteration of filtering, I'm chopping off data. So for example, if I start with 100 stocks, I may actually end up with 30 stocks out of the whole process, which is good enough from building a portfolio. So I'm not saying that good or bad, but the idea is this is what we call as hard approach, because we are very clear in our head. That's how we are going to deal with data. That's how we are going to build a portfolio. So that's one approach, which is usually followed by people. I don't know, good or bad. I mean, it all depends on the market, and secondly, what you want to achieve. Then there is another approach, what we call a softer approach in a way, where the idea is that we again look at the 100 securities that we had earlier. We look at the same parameters which are there, ROEs, debt to equity, price to earnings, price to book, and margin. Now, instead of putting like hard filters, what we do is we rank securities on individual criteria. Now, for example, first I will look at ROEs of all stocks, and I will rank them. The best ROE company will have a rank of 1. The worst will have a rank of 100. Similarly, coming to the valuations, the cheapest company will have a rank of 1 on PE and PB both. The expensive one will be rank 100. Then margins will be similar to the way we pick for ROE. So higher the margins, the better it is. So higher margin rank 1, worse margin rank 100. Now, once you've done that, as the next step, what one can do is one can combine these ranks by a way of, let's say, take a simple weighted average, a simple average or a weighted average. You come up with a rank, and then you do a one level more of ranking on that combined rank. Now here, I can still get top 30 securities at the end of this exercise. But the approach is different. The names which I get would be different to a certain degree from my approach 1. And the reason is, in this approach, what I'm doing is I'm not filtering out anything. Here I'm looking at the whole pool all the time. And by doing the ranking across different parameters and then combining them, I'm getting to a single number. Now, when I'm combining all the 5 ranks on debt to equity, ROE, PE, PB, and margins into a single number, that one number is driven by these 5 parameters. So assume a company which is at rank 1 may be expensive, but it has all the other 4 parameters which are in the favor of that company. That's why the company is ending up as rank 1. So the idea is that when I'm looking at top 30 stocks, I have to go a leg deeper to understand what is causing that good rank for the set of companies that I'm looking at. So in a softer approach, in the prior approach, it was like a simple chop off. So this is the result I have. But this is more nuanced. When we are building portfolios, in real life also, we have a lot of trade-offs, right? So a company with a very good ROE will seldom be available cheap unless there's something like seriously wrong on the growth side. So will you actually lose out on that company? So technically you're chopping off quality out of the first process. So your first process will lead to, when there is a hard filter, will lead to a certain type of bias in the portfolio construction. Whereas if you do a softer approach, there are fair chances that certain biases will get eliminated. And we will have a better understanding of, if a company qualifies to be part of the portfolio, what are the key drivers behind that company that qualifies them to be part of the portfolio. So these are the two aspects or two process or approaches that anyone can follow rather to build the portfolios. I hope that answers your question.
It does. To maybe summarize it for the audience. So I'll give an example of the coffee can rule. I'm mentioning this because I've worked on it.
Yeah.
So which selects return on capital, which selects companies based on two simple ratios of return on capital and revenue growth. Now, Chetan mentioned two methods to go about it. One can be the qualifying approach, wherein beyond a certain number or threshold, the companies are selected, everyone else is chalked off. The second approach can be not used and use an eliminative approach, but rather use a ranking approach, wherein stocks are ranked basis these two ratios. What it does is it will not maybe some signals or certain stocks which might have been missed out in the first part can be captured into the second. But I have a follow-up question here, Chetan. Should investors, while using a second approach, should investors also be putting some minimum qualifying range for certain ratios? Let's say, for example, if a certain stock has performed greatly in terms of price to earning valuation, it's very cheap because it's very, very poorly performing very poorly in fundamentals. Then we probably don't want such companies. Should such basic thresholds be placed in check?
Sure. I think it's actually a very good question. So the idea is that, let's say we again go back to our 5 parameters that we discussed. The 5 parameters that we discussed. So what is important relative to the other? Now, is PE very important versus the 4, or is ROE the most important one? Now, these are the kind of questions that you will keep thinking when you're looking at the data set. So like you rightly mentioned, what we should do is, we don't want to put companies which are like too terrible on one parameter, but that gets averaged out in the whole set. So what we will do is we'll create certain boundary conditions, or I usually call it like a hygiene cutoff, where, for example, if let's say debt to equity for a company, if I rank them, I would not take anything which is higher than rank 80. So that's like a hygiene cutoff for me. Now, the difference between this approach and first approach may look like a hybrid, but here the idea is that I am not like slicing the data at a specific level. I'm doing it on a rank. So every time at least 20 stocks on debt to equity will go out. If I do this rebalancing exercise on a specific frequency, the numbers may change. Sometime of 81st rank company may have a debt to equity ratio of 2x. Sometime it can be 4x. So here, instead of like fixing myself on a 2x number, I'm saying the worst 20 companies in the pool of 100 has to be chopped off. So that's how you can create certain hygiene conditions based on your requirement and on your data. So if you have a big pool, of course, you can do certain hacks like that.
Got it. So hygiene-based filters based on absolute numbers, or maybe more preferably based on ranks, can still be deployed with the ranking method.
Yeah.
That's very clearly put. Nice. Okay. Next, I want to cover diversification. Probably diversification becomes even more important in quant, where business or economic trends are attempted to be captured, and elimination of the idiosyncratic risk or noise with particular security needs to be absolutely avoided. So also a major and second part is that there is a major advantage of quant, which is immense width of opportunity set at our disposal. So I want to cover both these together. how should both diversification and the large opportunity set be seen when practically building an investment?
So, Kislay, I think one thing which actually I've learned a hard way is that having a lot of data, having a big pool of investable universe gives you a false hope of diversification. Because what happens is we run our quant strategies, or quant rules, so as to say, on a big universe. But the idea of diversification is ensuring that have like very limited blind spots. Because here we are doing analysis at scale. That is what quant offers. That's the USP. Now, in that case, if I'm building a diversified portfolio, the advantage for me is that I have looked through the lens of my rule, the whole universe, and then I filtered those stocks. Now, there can still something which can go wrong. Now, if something goes wrong in the stock, I am not blown away. My portfolio risks are under control. That is what the primary objective of diversification is. In a real world scenario, sometimes if I'm working, let's say, with an index, and the index is very narrow in the sense that let's say there are 50 stocks, but top 10 or 15 stocks account for 65% of the weightage of the index. That becomes a challenge for creating a diversified portfolio. Now, if I go too different from the index weight, actually I'm taking a active call on a lot of stocks. So I can't go equal weighted. Let's say I'm picking 30 stocks out of those 50. And if I do equal weighted, assume that the large stocks which have higher weight in the index, they perform pretty well. I have them in my portfolio, but the allocation levels are much lower than what ideally I should have. I will underperform. So that's one challenge. So just the name count in the portfolio does not guarantee diversification. What one has to think about is not parameters like liquidity as well. So normally what happens is in the market, all of us know that correlations actually increase when the markets are going down. When the correlations go up in the down markets, the other problem is the liquidity dries up. So on paper, I may have a diversified portfolio, but in the bad time, I may not be able to experience that benefit of diversification. So one has to be very careful as when they are curating their own portfolio, that how much allocation should go to a specific stock based on the worst case liquidity that the stock has experienced over, let's say, a certain period of time. So there are a lot of aspects where we're building the portfolio and we talk about diversification. The baseline is the risk. And one has to put the lens of risk every single time when we are thinking about diversification. Returns follow if the risk gets controlled. So the whole objective of diversification, one has to look at data to insight from the lens of risk. So that's how I'd like to put it for you.
Okay, got it. So basically, we have to see it in conjunction with other risk factors like liquidity and high correlation in worst periods.
Yeah.
Okay. Next, sort of relative topic, which you mentioned, that how should diversification be seen, and consequently, with diversification in the number of stocks and the allocation that we have chosen, another question that comes into picture is how much is our holding period? That is somewhat captured in the portfolio turnover or churn of a particular investment strategy. Now, short holding period, a high portfolio turnover is often touted as criticism of quant. A reason being that impact cost rises probably exponentially as fund size increases if the strategy involves high churn. Now, from you, I want to know, how should churn be seen, and how should it be seen differently from an investment perspective versus trading perspective?
Yeah, I mean, I'm of the believer that churn is bad, so I'm actually very wary of any statement which is very blind. So, or a very deterministic statement that churn is bad. I'm usually away from those camps. Or a buy and hold is the only way of investing. So I don't prescribe to any of those hardline thesis. The reason is it matters in the context in which you or me are operating. The market scenarios are different. Our limitations are different. Then when we are looking at churn, if you go back and look at the numbers recently, there are a lot of mutual funds which report very high churn, but the returns have been like amazing. So can I statistically or can I prove it with data that having churn is bad? Now, what one has to understand with churn is like a decision, which we discussed earlier, right? I mean, every decision has a cost. So similarly, churn has a cost. So the idea is if I churn, there's no problem. If I'm making return, which is higher than the required return to beat the benchmark plus the cost of that decision. If I'm able to manage these two things together, I will outperform the benchmark or for that matter, even my peers. But the idea is that just thinking that the churn is bad, if you made a bad decision and just sitting on it, hoping for the stock to turn, actually lead to a bigger drawdown. So in a way, I think the approach taken by the traders and the investors both have a lot of merit. And instead of just subscribing that I'm a trader or I'm an investor, if one is open-minded, especially when you're operating in a quant scenario, one can balance both these approaches pretty well because you are more data-driven, you're more open-minded. And we have discussed, and I've talked in a lot of my workshops which I've taken for CFA Institute, is that the market cycles are actually shrinking. And if the market cycles are shrinking, should our holding periods too? That's one question one has to ask. If the earlier holding period were 10 years, should I reduce it? So there's no straightforward answer to this. It all depends. It all depends on your investment objective. It also depends on the kind of stocks that you own in the portfolio. So just saying that churn is bad, I don't subscribe to that worldview.
Okay, that's an interesting view. So what I get is while high churn is not necessarily bad, or necessarily too much churn is not necessarily good. It should be in the context of what we are doing. But most importantly, what I got from you was that is there an analysis or a study that shows that high impact cost with high AUM size and high portfolio turnover is detrimental to the returns? Now, this is the type of questions that I hope the listeners take out from this, which is if we have such interesting questions, we can build a hypothesis around it and test it on our own.
Yeah.
Okay.
So just like to add one point, mostly for churn, what one has to look at is the higher hit rate. So normally what happens is we confuse ourselves. We just look at risk and reward. Now, there's no harm looking at risk and reward. So risk and reward has actually two components to it. How often one is right? That's one. Second, when you're right, what percentage of your reward you are capturing? And when you're wrong, what percentage of your risk you are actually cutting your positions at? Now, just thinking, if my risk and reward, just to keep it simple, is 1:1, no one does that, and your hit rates are at 50%. Now, assume when you are right 50%, are you selling off your positions at 0.8 times the gain that you had expected? And on the flip side, when you're wrong, are you holding your stocks at a 1.2 times the risk you had measured for this trade? Now, in this scenario, there's a lot of psychologies at play. So just using quant to build portfolios, using quant to rebalance does not take away our biases. So one has to be very open-minded as to, does my process sound enough? Do I work with a very high hit rates? Then the churn can be high for me. But if my hit rates are low, my churn is high, that means I'm taking more decisions. And if I have a psychological limitations in terms of capturing the risk reward optimally, that's actually a recipe for disaster. So one has to be very, very careful as to the place where they are operating in.
And this reminds me of a popular quote by one of the very famous investors in India, which roughly translates into how right you were when you were right, how wrong you were when you were wrong, or how much did you gain or how much did you lose when you were right and wrong, respectively.
Yeah. And George Soros, I think, also says the same thing. It doesn't matter how often you're right or wrong, but it matters how much money you made when you are right. So it's basically the position sizing argument around that. It's slightly different though. Yeah.
Yes. Yeah, slightly different, somewhat related though. Okay. Okay, next, now that you have mentioned position sizing, the next question is on position sizing. Can you give a practical guide on how much of percentage allocation to different securities in a portfolio be given? How this position sizing should be objectively determined? We discussed building hypothesis. Should hypothesis around position sizing be also built and validated?
There's no such thing as hypothesis around position sizing because, if I just talk about a study done by Motilal Oswal sometime back at Reddit, if you have around 30 odd stocks in your portfolio, every incremental stock will not add too much to the diversification benefit of the portfolio. So when we are talking about position sizing, we have to think both from a return and risk perspective. When we are talking about diversification, which is like the name count, spread, and all that, then we focus on risk primarily. So now when we are talking about position sizing again, and I'm choosing those 30 stocks, roughly if I divide 100% of the money which I want to allocate around those 30 stocks, the average weight would be around like 3.33%. Now that's my starting point. Now, where will I increase the allocation and where will I reduce the allocation? That is the decision we have to take for each stock in the position sizing exercise. So the point which we were discussing earlier around risk reward, that forms one of the basis of it. But apart from that, I think a very important parameter is around conviction. Which conviction is telling me that the hit rate which I modeled earlier, let's say the trade will go right 70% of the times. Now, what degree of confidence I have that I will actually end up on the 70% side and not on the 30% side? That is what determines the conviction. So if I'm convinced 100% that I would be right, just think about it. Why will I not put even 100% of my capital in a single stock? Or I'll go with a concentrated position. It doesn't happen in the real world, but the idea is that one should be thinking in those lines. That combine your risk reward with the conviction together. The way I think about it is one should not limit themselves to one single framework of thinking. Because what happens is we, in analysis of data, we also do an exercise called as triangulation. So the idea of triangulation is that I'm looking at the data from one angle. I come to a conclusion. Then I leave the conclusion there. I start looking at data from some other angle or even a other data set for that matter. I do some analysis and I come to a conclusion which pretty much matches what I'd done in the first iteration. Now that tells me that if I approach data from left and if I approach data from right, I end up with the same conclusion. That gives me conviction. So that's why when we are thinking about position sizing, one has to think from different framework perspective. So let's say momentum can be one, quality can be second, valuation can be third. Just think about it. If you have a quality stock available at a cheap valuation and the momentum is in your favor, you can actually allocate more. If you think it's a quality stock, valuation is cheap, but momentum is missing, then maybe you go with a standard 3.33% allocation in that stock. If you look at a stock which is very good quality, slightly expensive, momentum is missing again, or there's a negative momentum. If you have to invest, build a quality portfolio based on your mandate, then you might think of allocating, let's say, 1.5%, which is like even half of the position that you normally allocate. So the point which I'm trying to emphasize on is just don't fix yourself that I've created a portfolio based out on the quality framework, and I would just want to do a position sizing based on that quality framework. Blend valuation, blend momentum, blend whatever other parameters that you think are important. Let's say interest rate regime can be one from a macro standpoint, or how currency is behaving, that could be another. So when building position sizing, the whole idea is that how can I derive higher conviction? And where can I derive higher conviction? Higher the conviction in a specific stock, go for a higher degree of allocation.
Very interesting approach to position sizing that you mentioned, that apart from the risk reward methods, conviction and signals from multiple sources can be used to arrive at position sizing numbers. Great. Now I want to cover the very important topic of backtesting. We know that one of the biggest advantages of rule-based or quant-based approach is validation through backtesting. It allows investors to assess performance using historical data. Now, can you share some insights into this crucial step? It's often misunderstood and often discussed very widely. Why is it important? What are the common pitfalls associated with backtesting and the best practices one should follow?
Sure. So that's one of the questions I get asked like very frequently when I present any of the quant model. The first question, I think it actually tells me a lot about the audience. So I am looking at the person who's the first one to ask me what are the hit rates of the strategies that you're discussing. Because I mean, it's just joke. But the idea is we are looking for a holy grail, all of us. Now, hit rate gives that false confidence to people that based on backtested data, if the hit rate is 80%. Now that 80% is like an anchor to the person who is listening to me discussing that strategy. But what they don't understand is that under what circumstances those 80% hit rate are coming, what kind of data I'm looking at, what are the parameters which go into the model, and do they make sense? See, that's the last point which I mentioned is like, in my opinion, very important. Most of us, when we borrow, let's say, a algorithm, even for example, you have done a extensive research on coffee can portfolio. If I just borrow your coffee can portfolio, if I want to run it, I don't want to invest. So for example, if you are running it, you have done the analysis, I can be an investor, no problem with that. But if I'm given that portfolio strategy to run, I need to know not just the hit rate, but the relationship between the parameters that go into building that system. Under what conditions those returns were, we got those returns. What are the return distribution under different scenarios? Where are the outliers? What are the average numbers? And most importantly, when did the model did not work? That's, I think, one of the biggest thing which people fail to question. That it works 80%, but it doesn't work 20%. What are those scenarios in which it doesn't work? What kind of drawdowns we can experience in those 20% of scenarios? What are the kind of losses we can experience? Now, if I give you a scenario that in 80% of the times you can generate 50% of the return, and the 20% of the time when actually your capital can get wiped out, I'm pretty sure that no one would actually invest in that kind of a algorithm. Because the worst case scenario, I mean, a lot of people may be aware of the expected value where you multiply the probability of being right multiplied by a reward of being right minus the probability of being wrong multiplied by the loss that you experience when you're wrong. Now, theoretically, it may sound okay that it's still a positive expectancy. But you know what? How positive expectancy? 80% of the time, I'm getting 50% of the returns. So that means my positive expectancy is 40%. Negative expectancy is 20% of the time I'm losing my capital. So 20 multiplied by 100%, which is 20%. So if I just do the subtraction, that's 40 minus 20. So I still come up with a positive expected value of 20%, right? Now people will say, oh, it's good. But what could happen if the first scenario that we run the next time is that 20% scenario? You're actually wiped out. So one has to understand not just that what are the bad scenarios and what are the extreme instances of bad scenarios as well. So backtesting has to answer all these questions. So backtesting is just way of basically looking or reflecting in your life. When you're writing an autobiography, you're not trying to forecast anything. You're trying to make sense of what has happened in the life in the past. So that is what I would classify backtesting as.
It brings me back to the previous point that you mentioned, that when we are looking at data, and be it even backtesting data, it has to be analyzed from every angle and every lens. Not just the average return, not just the properly weighted expected return, but also the worst cases, the best cases, in what market scenarios it didn't perform, and so on, so that a more informed approach towards investment can be done.
Yeah.
Okay, I think with that, we are at the end of the podcast. Finally, Chetan, I would request you to give advice you would have for listeners, individual investors, research analysts, or fund managers, and or ones who aspire to be one. How they should, what is the takeaway they should get from this podcast?
I mean, from the process that I use, there are two key takeaways. One is iterate continuously, keep building the model and keep improving it. At the same time, second is don't over optimize. So what happens is when we have like a lot of data, there's an innate urge in us to optimize the outcomes and try to do a data fitting sort of an exercise. The more we optimize anything, we are making the system more rigid. and the rigid system will not be flexible under different market conditions. So when we say investing is an art, but also a science, so the idea is that you build the models from a scientific method, but keep them loosely connected or enough connected with each other so that when the market regime changes, they're able to adapt. So that's what I would like to give like my 2 cents on building models around quant.
Superb. Thank you so much, Chetan. This was truly an insightful conversation that would be very special. And I hope the listeners got something useful out of it. Thank you so much for your time. Thank you so much.
Thanks, Kislay. Pleasure is mine. Thanks for very good questions. Thanks.
Thank you.
Thank you for listening in to today's podcast. Before you go, please subscribe to stay updated on your favorite podcast app.